What's up, guys? This is Joshua Harmon Sr. If you don't know me, I'm a real estate agent with Keller Williams Platinum Realty in Fort Smith, also a real estate investor focused on apartment buildings. And today we are going to go through a deal analysis. We're going to look at a real deal. It's June 24th, 2019. So if you check this video out later, this deal might be gone, but on June 24th, 2019, this deal is going to hit the market. It's a 4-unit property in Charleston, Arkansas. It has all 2-bedroom, 1-bathroom units. Charleston, Arkansas is a small community outside of Fort Smith with 2,500. It's a 2,500 population. I think Fort Smith has about 90,000 people in the city of Fort Smith. So if you're living in Charleston, you're probably commuting to Fort Smith for work because I don't think there's very many job opportunities in Charleston outside of the school, outside of the public school system. So you're probably commuting to Fort Smith, but it's a beautiful small town. I know a lot of people who live there and they never want to leave. They grew up there and they can really find the beauty in a small town feel. Me, I'm a large city guy. Fort Smith still gives me headaches sometimes because sometimes I'm just used to living in Richmond, Virginia, where there's about 200,000 people there. So basically double the population. But I love Fort Smith as well. So we're going to go through this deal today. And one thing I want you to look at when you're analyzing this deal and when I'm talking about this deal, even though this is my listing, as an investor, the way I look at deals from a real estate agent lens and a real estate investor lens are two different lenses. So as a real estate agent, I'm going to be more aggressive, meaning that my expenses aren't going to be as high. I may not throw in a CapEx budget. If the owner tells me he doesn't have any vacancy, I'm not going to add any vacancy. But as a real estate investor, I'm planning for the worst possible things that can ever happen, which is it's going to cause me to lose out on some deals. But at the same time, you have to protect yourself, your partners, your investors, and make sure you're able to return their initial capital first, because this deal is $152,000, which is going to take a $30,000 down payment. First of all, you want to return the $30,000, but on top of that, you want to make a return on that $30,000. So you want to make a 8, 9, 10% return on that money. But first and foremost, let's just make sure we can get the money back. Because worst case scenario, if all you can do is get your down payment back, you have 2 real buildings with 4 real residents living there, and eventually you're going to if you're able to get your money back, you should eventually be able to get a return on your money, because it's a real building. It's not a stock where the company's just going to liquidate one day and there's nothing you could do about it. These are real buildings with insurance on them. Let's just say they burn down. The insurance company's going to give you the money to build them back up. So, like I said, through a real estate investor lens, I'm going to look at things through a worst case scenario. But as a real estate agent, sometimes I have to be aggressive for my clients. So I'm going to give you 2 ways to look at deals based on the packet that I put together. But also, sorry about that, my battery's going dead. So I'm going to give you analysis through a real estate agent lens that you're going to get from real estate agents and brokers that are going to be a little bit more aggressive. But I'm also going to break those numbers down and show you how you could be not only more aggressive, but also show you how to calculate upside on a deal. So I'm going to direct you guys to my screen. I can't get my screen share to work, so I'm just going to flip this camera around and let you look at my screen. So give me one second. As you guys can see here, the address is 717 6th Street in Charleston, Arkansas. The asking price is $152,000, which is about $70,000 per duplex, which is a really good deal. Give you guys a look at some of the interior pictures. Here is it has laundry hookups with a small towel cabinet area above the laundry hookups. The equipment is owned by the residents, so that is not conveyed with the property. Here goes the living room here. As you can see, there's laminate flooring. The paint is in great shape. Here goes the kitchen here on the left. Nice cabinets, white appliances. The appliances will convey with the property. Cabinets have been painted. I don't know if you can see very well in this picture here in this bedroom. The flooring is carpet in the bedrooms, so you don't wake up and your feet are freezing. So I think that was a great touch there. The bathroom, the picture isn't, it was kind of cropped. so you can't really see the bathroom, but the kitchen and the bathrooms have tile flooring. So these duplexes are in great shape, interior wise. Exterior, I think there could be some value that could be added. Maybe paint the brick, at least do a power wash. You can see here there's some water that builds up, and there's no foundation issues. There's no cracking in the brick, but it does have some wear and tear on that brick. I think the softening fascia can do some can have some updating there. I like the columns that they have. It's a gravel driveway, so I think it can use some more gravel and also some weed control. The lawn care guy should be taking care of those weeds so they don't grow through the gravel. But I'm gonna kind of blow this up here. If you could see on this left-hand side, here goes Fort Smith over here on the left, and Charleston is right outside of that. So it's about a 30-minute drive to Fort Smith. And yeah, very small community, but there is a rental market there, and there are people who love to live in Charleston that would never leave. The thing I like about this deal, I'm gonna blow this up a little bit. There's 4 units, 840 square feet per unit, which is an awesome size. I really like to stay away from units that are in that, that 500 to 700 square feet, because they're very small units, especially a 2-bedroom, which these have. These are 2-bedroom units, so I think 840 square feet is sufficient space for a 2-bedroom. Another thing I love, it was built in 1996. So it's a newer building, built within the past 25 years, so you won't see as much repairs and maintenance as what you would see on a 70s or 80s build. And here it goes again, the 2-bedroom, 1-bath units, brick siding, asphalt shingles on the roof, gravel driveways. Let's go through this financial analysis, I think is what's next. All right. Okay, so the gross rental income is $19,200, and that's without factoring in any vacancy based on their current rental rates. So if you see over here on the right, what the units are renting for, 2 units are at $425, 1 unit is at $350, and 1 is at $400. And what I will say is they're all pretty much updated to the same standard. It's just based on their tenure of where their rent is. The newer residents are paying a little bit more. So if he were to have some turnover of those 2 units, the owner will probably raise the rent. But if someone was to acquire this property prior to any turnover, you would have a lot of upside here to raise rents. So I try to be more conservative with my analysis, and I'll say, hey, look, forget what everybody else in the market is charging for rent. Let's just say we can raise these two units who are below what unit A and B are paying. And if I can stabilize rents at $425 across the board, that'd be a huge deal. But look, anytime you're analyzing the deal, initially, you want to analyze it based on what you're going to be buying at acquisition, not where your projections are coming in. Better yet, don't even analyze the deal projecting any rent raises going forward. And if it's a good deal there, then you can already project that, hey, look, my 12% return could be a 20% return. And I think investors and partners will appreciate that conservative underwriting. They don't want to see someone who's just saying, hey, look, I'm going to raise all the rents up to $475. Well, maybe these 2 units that are at $425, conservatively, you can say, hey, look, maybe I can get $450. But raising rent from $350 and $400 all the way up to $475 and $450, I mean, that's a huge rent bump. So partners who you want to invest in your deals and passive investors that you want to invest in your deals, they're not going to feel as comfortable with a $125 rent bump as a projection. So that's something that you probably want to steer away from. The current ownership didn't have any vacancy in 2018. But when I did on my underwriting, I just went ahead and said, hey, look, a 5% vacancy rate. Whenever you're transitioning ownership, there's going to be some long-term tenants who don't feel comfortable. They probably are used to the rules and kind of with the old ownership, how they ran the property. You may be a little bit more strict than that old ownership. So let's just go ahead and project a 5% vacancy rate. This is their actual insurance, their actual taxes. Repairs and maintenance, I made some notes on the side. They said their repairs and maintenance was significantly less than the 10% vacancy rate. But look, I just used the placeholder for properties built after the 1990s as a 10% vacancy rate. Anything built in the 80s or 70s or anything after that or before that. I usually say 20%, just because it's an older build property. So I did 10% repairs and maintenance here, and my net operating income, which is defined as your your net rental income before any capital expenditures, which are your roof, your plumbing, your electric, your HVAC, and your debt service. So when somebody's giving you a net operating income, there's still more expenses that you need to factor in. They're just not used to factor in your valuation, because everybody's debt's going to be different and everyone's capital expenditures. Capital expenditures are used to improve the property. So that's not going to be an expense per se. It's going to be an expense in your pocket. But for one, you could write those capital expenditures off on your taxes. And two, those are used to improve the property because you're replacing something and not just repairing it. So we're going to get deeper into the financials. So the net operating income is the $13,670. Debt service, I have just under $10,000, and that's based on a 20% down payment, which is $30,400, 20-year amortization, and a 5.25 interest rate, which is about what everybody's looking at right now. Banks are not really into the 5%, 7%, 10% down payments right now. And to be honest, something that I talked about a little bit on my past videos is about having your own money and bringing your own money to your deals. And the reason I say that, if you put 10% down on this deal, it won't cash flow. You put 5% down on this deal, you're gonna lose money, and you're not gonna meet requirements by your lender at acquisition. Now, you may be able to add value and then cash flow just fine, but like I said before, you want to buy your deals being able to cash flow at acquisition. You don't want to buy, even if it's value add, even if you're gonna go in and get rid of all your residents one by one and renovate their units and put new residents in or raise the rent. You want to be able to, while you're doing those value added services and you're repositioning the property, you want to be able to fall back on the property still cash flowing. So that's why I threw in the 5% vacancy rate, and then saying, hey, look, I threw in the 5% vacancy rate, and I wanted to show that you can cash flow it right now without doing anything. And then any value that you add is just icing on top. It's just additional return that you can be able to return to your investors or your partners or just to yourself. So by putting 20% down, your debt service is $9,912. Projected net income of $3,758. $3,758, and based on a $30,400 down payment, that's a 12.4% return. Now, there's also the debt service coverage ratio, which your lender is going to take a look at. They want at least a 1.2% debt service coverage ratio, or a DSCR. That's your net operating income divided by your debt service. So that's your net operating income, which is your net income before your debt service and CapEx budget, divided by your debt service, which are your loan payments, your annual loan payments, which gives you a 1.38, which will meet your lender's requirements. Now, are those things that I want to pick at my own numbers, because I want to be even more conservative when I'm talking to you guys. As a real estate agent, I'm going to analyze it this way and not add on any additional things. But the buyers who are going to be interested in this property may pick these numbers a little bit. They may throw in a CapEx budget of 10%. Like I said, with 1990s properties, you're not going to have a 1996 property. I'm sorry, you may not have a lot of CapEx like roofs, HVAC, plumbing, electric type of repairs you need to do. But let's just go ahead and budget in another 10%. So another $1,920 to this. And let's do that math real quick. So we're going to track $13,670 minus another $1,920 for CapEx. It's going to give us $11,750 for our NOI, or our net operating income here. And we're still going to subtract, this is not going to change our debt service, so we're going to subtract that from our debt service of $9,912, which give us a net income of $1,838. which is significantly less. So this is pretty much half of the projected net income that I show, which is going to put you at about a 6.2% cash on cash return. So let's go ahead and do that math real quick. So the cash on cash return is based on your projected net income divided by your down payment. So cash on cash return is literally what it's saying in the title. How much return are you going to make on your cash that you've invested of the $3,400? So the $30,400. And actually that's a 6% return. So how do you add value to a deal like this? Can you still buy a property full price and still make a return? Yes, you can. So let's just say we are able to raise all of the rents to $425. So $425 times 4 times 12. So that's going to bump us up to $20,400 for our gross rental income. Now, some people may say, well, isn't that going to change your vacancy rate? Isn't that going to change your repairs and maintenance? No, it is not, because literally what it's doing is you're just adding, you're just bringing them up to market rent. Like I said, these units are updated the same. It just depends on the tenure of the resident as to where their rent is right now. So you wouldn't have to do any repairs to raise those rents. Now you may need to turn over those residents because they may not want to go up from $350 all the way up to $425, but you won't have to change any of these numbers in order to raise the rent per se. So let's just say, what's the difference between $2,400, $19,200? So it's a $1,200 difference. So we'll add that to our $13,670, and then we'll subtract the $1,920 for our CapEx budget. So that gives us a net operating income of $12,950, which is pretty close to what I had. But you don't want to factor that in on the front end. This is the value you're going to add. So you don't want to buy properties saying, hey, look, you don't want to buy properties from an owner and he's analyzing the property saying that the net operating income is $12,950. You don't want to give away all your upside while you're purchasing a property. You want to be able to reap the benefits of the work that you're going to have to do to raise the rent up to $425 across the board. So the projection that I'm going to show is I'm going to say, hey, look, it's a 6% return on the front end based on the numbers that the owner provided. But this is me adding my value. And this is what I'm going to show my partner. This is what I'm going to show my lender. And this is what I'm going to show any passive investors I have in the deal. So we're going to subtract the $12,950 from the $99.12 debt service, which gives us a $3,038 projected net income after all expenses, and we're going to divide that by our $3,400 down payment, and that gives us a 10% return. So a 9.9% return, which is a really, really good deal. Yeah, that's and here goes my contact information as well. But yeah, these are the type of value add deals that I'm finding in the market, and I think this would be a really good deal for somebody in the River Valley, which is basically the Fort Smith MSA or Metro Service Area. And this is how you should analyze a deal. You know, you may the packet that you get from a real estate agent, you may need to tweak those numbers a little bit to fit your underwriting style. But ultimately, there's a lot of information that could be had from a packet like this that you get from your real estate agent. Based on, I think that, yeah, you need to take everything you hear from a real estate agent with a grain of salt, but there's a lot of information that was in this packet that I was able to use to my own advantage to analyze this property and show some upside. Like, everybody's analyzing skills are going to be a little bit different, but at the end of the day, in order to be an investor, you need to be able to look at the numbers that are in a packet. You have to know your market in order to say, hey, look, I am not comfortable with saying that we can raise rents to $450, but hey, I feel comfortable saying we can raise rent to $425 across the board. And then also having just having the knowledge about your market to say, hey, look, I need to go ahead and add in a 5% vacancy rate, although that they didn't have any vacancy because I'm going to be a new owner. So there's a few things that I've learned over the years that have given me kind of insight on how to analyze properties very efficiently. And I think this is a skill set that anybody who wants to be an investor needs to have. Any packet that you get from like I said, any package you get from a real estate agent, you need to take with a grain of salt. Any financials you get from an owner, you need to take with a grain of salt. You need to, because ultimately you're going to be the one putting $30,000 down on this property. And that's not going to be easy for anybody. I mean, whether you're a millionaire or you're, living paycheck to paycheck, making $60,000 a year, coming up with $30,000 is a big deal for anybody. So you need to analyze these properties, knowing that you're going to be able to make a return, or making offers on properties with the mindset that you're going to be able to make a return on this property. So I appreciate you guys going through that deal analysis with me, so you can kind of get an idea of how I analyze deals. One thing that I didn't factor in on this specific deal is management. Now, when you're going through your deals, you always want to factor in management, unless it's a very small deal. So the way I look through things now that I've been looking at very large properties is I've seen people with 100 units and not get the focus of their property manager, let alone 4 units. So when you're dealing with a 4-unit property, you got to think about things. The most that a property manager is going to charge you is 10% of your gross income, your gross collected income. So let's just say your gross collected income is $19,000 here. 10% of that is not $1,900. Why in the world would a property manager give you their 100% focus to make $1,900, not a month, but a year? There is no way that a property manager is going to give you the focus that you need. And also, if you guys are beginning investors, I suggest that you manage some of your properties that are this small on your own. Now, if your first deal is 15 units, 10 units, 30 units, then maybe go ahead and hire out a property manager. But when you're dealing with something this small, I just can't see how a property manager can make sense of dropping everything that they're doing to focus on your 4-unit property that's only going to make them $1,900 a year. So I suggest that you may manage this property on your own. And maybe, just like I said on the last video, build your team up so that you do have those resources if something went wrong, that you can call on those people. I would probably still get the expertise of a property manager and make sure my projections are in line. But I probably wouldn't hire them based on how small this deal is. But I appreciate you guys, like I said, watching this video. I try to bring as much value as I can, and not give you so much of the fluff that you may hear from other real estate investors. If any of you guys have any questions about this deal, or if you have a deal that you'd like me to take a look at to help you analyze it, you can send me an email at joshua.harmonsr@gmail.com. That's joshua.harmonsenior@gmail.com, and I'll be happy to take a look at your deal and see if I can be of any service to you. So we will see you guys next, well, actually today is Monday. I'm going to make another video this week. So yeah, I'll see you guys later on this week.